right, so Shashi, I start recording.
Perfect. So let's start then. So hello, everyone. Welcome to this week's event of the Accounting Design Project. So I am Xiaoxi Wu from Bocconi University, and I will be moderating the session today. Okay, so first, please allow me to welcome today's presenter. We have Ayung from Georgetown, and then we also have Waqar from INSEAD. Okay, so they will present a very exciting new paper, which is titled The Effects of ASC 606 on Revenue Recognition. So before the presentation, just a few ground rules for the event. First, the presenter is happy that the participants ask questions anytime during the presentation. So if you want to ask a question, please just use the raise hand function, or maybe type in the chat box to indicate that you want to ask a question. Then I will call on people in order. And then please do leave the last 5 minutes uninterrupted for the presenter. And also please feel free to stay after the presentation if you want to chat. And I think, yeah, that's it. So now we can kick off. The screen is all yours.
Thank you, Xiaoxi. And first, I want to thank everybody for coming. I'm very nervous that this is my first time presenting on this ADP project platform. I started this project during the summer of 2020 when Steve and I both talking about this project. It kind of motivates me to actually head into this new direction, try to work on more measurement related kind of like research questions, and then try to implement those measurement ideas into empirical design. And luckily, after 1 year, after collecting some of the data related to 606, I met Waqar. He's a fourth-year doctoral student from INSEAD. Waqar has many years of public accounting experiences in London, helping a lot of clients implementing revenue recognition and many new standards that we have seen today. So Waqar is with us today, and then I will be presenting, but Waqar will jump in with some of the anecdotal evidence and stories whenever needed. So let me get started. So the motivation of the paper is we want to communicate with all the users of accounting revenue. So accounting revenue here, I mean that the revenue produced based on the US GAAP or IFRS accounting standard. So in the economy, there are many different ways to produce this revenue number. Sometimes firms will use the tax kind of return rules to actually produce the number. So I just want to clarify that the revenue numbers we are interested in here is the accounting number compliance with FASB and IASB's accounting rules. And the first group of the people we want to talk to are the current and the future users of accounting revenue. So when we think about we are teaching students about those new standards in the classroom, how do we really articulate the impact on recognition after those firms implement those new standards? I taught these standards for probably 4 or 5 years. It's very hard for me to actually answer students' kind of question in 1 or 2 sentences. And that's kind of motivate us to actually work on this project. And hopefully we can provide some of the large simple kind of like economic effects on the measurements for us to communicate with current, existing, and the future users of accounting numbers. And accounting, those revenue numbers are everyone we know that's either from managerial or financial accounting courses is a very important number because internally firms use historical revenue numbers to actually budget their future sales growth and thinking about whether they need to invest more or less in terms of their capital and the human resources. Externally, all the capital providers start their valuation model from forecasting sales revenue numbers in order to actually thinking about whether the firms they actually invest in are able to pay them back. So it's a very important number used by many constituents across the world across different economies. The second group of people we want to kind of like convey with are the standard setters. So since 2018, all the entities, regardless of their ownership, regardless whether it's for-profit, not-for-profit, publicly traded or privately held, across all the industries within US or outside of the US, all are actually required to adopt this new revenue recognition standard. So the initiative of this new standard is try to unifies or synthesize all those industry or transaction specific rules. So you can think about, if you are the standard setter, if we are going to actually regulate or specify a specific recognition rule for a specific narrowly defined transaction or industry, it's easier for you to tell those constituents what specific timing to recognize what portion of the revenue. But if you want to actually synthesize across all the industries, across all the different transactions, even for future transactions that we don't really see today, you are more likely to actually adopt a more principle-based approach, because that's more likely to be generalized across all the different situations. And that's kind of like what happened to this new standard 606 and IFRS 15. It becomes more principle-based, and mainly it's kind of like going back to the sales contract themselves and asking firms to actually analyze those individual sales contracts in detail to apply those 5-step conceptual rules. So a lot of kind of wiggly rooms and then judgments and managers need to exercise in order to implement this new standard. But that is the distinct difference from the previously more than 200 rule-based kind of like standards. So when I talked to kind of, and Waqar as well, talked to some of the practitioners, and also I talked to Bob Peirce, the former chairman of FASB, when he was kind of like in the conversation drafting this standard, what I find out is that ex ante is very hard for firms to actually predict what would happen after they implement this new standard, because pretty much this new standard changes the unit for recognition. It's not simply mandating the speed of the recognition. For example, some of the technology standards, I think Anoop actually studied in the past, was specifically saying that for this particular industry transaction, starting from 2005, all the revenue recognition will be accelerated. For example, from the last date of the sales contract to the first date of the sales contract. So those will be like ex ante, we are able to see what exactly we expect to see in terms of reported numbers will behave after the adoption. For this 606 new revenue standard, they changed the unit for recognition, but we don't really know after this implementation what exactly the reported numbers will behave. The difficulty even for specific adopting firm is that very likely the firm did not keep track of the detailed information from individual sales contracts before the announcement of this new standard. So, for example, yeah, Luminata, do you want to ask your question?
Yeah, I was just thinking, like, can you say that the complexity for the users of this information, for the preparers of financial information, did increase or decrease after the adoption of this new 606 topic?
I think for user, let me talk about the producer. Producer, this 606 requires a more granular unit. So in terms of complexity or disaggregation, they are required to collect more detailed information. So the unit is mandated in the standard is the distinct performance obligation, right? So let me give you one example, is that in the past, these manufacturing firms keep track of their revenue generating process based on the number of container ships or trucks actually moving out of their port or warehouses. So they recognize revenue in batches of revenue, and they keep track of those batches, right, whenever moving out of their warehouses. More precisely, sometimes the manufacturers or producers can put RFID chips into individual physical goods, so they can keep track of those goods units and then to see when those goods are delivered. When they have to implement this new standard, they not only need to know each individual goods are shipped to which customer, they also need to identify individual contracts within each customer associated with each unit of goods. And then within each contract, they also need to further collect distinct performance obligation, and that requires non-trivial analysis of the complementary relationship between physical goods and some of the performing services, and then for them to actually identify the distinct obligations. And after all that analysis, you think about the company need to automate this system right, to change their internal information system or ERP system. So going forward, they don't need to go through this manually on an ad hoc basis. They actually able to actually create some modules in the ERP system to actually going forward, whenever they sign a new contract, the system, the algorithm is able to analyze the sales contract and determine the distinct performance obligation and then triggers each point for revenue recognition. So the short answer to your answer is from the producer's part, it's very costly for them to adopt, and then, but eventually they will actually have a more detailed, more granular information at the performance obligation level for them to actually learn about their reporting, to comply with the reporting purpose, but also learn more about their business. But that's why a lot of adopters actually push back the effective date after they first announced in 2014 and saying that it's actually very costly, because the first step is to identify sales contracts. If their system did not keep track of sales contracts automatically, they need to go back to their sales group and then find all the contracts either in papers or in the system. And those are probably not aggregated when they first learn about this new standard. For the users, I think there's a concurrent paper how these aggregated information firms actually are willing to publicly disclose in their Form 10K after the adoption. And again, that is a voluntary disclosure choice. That internally, they are required to actually keep track of data, revenue related data at the performance obligation level, but externally, whether they are willing to actually reveal that level of the details, there's many disclosure hypotheses will tell you that they may not. So they do see the cross-sectional variation across firms. Some firms provide more disaggregated information segments for revenue reporting. Some firms do not. And then that's kind of like, I can direct you to that paper who analyzed that choice. Yeah.
Right. Yeah, I mean, not to advertise my own research. We just finished a paper on looking at the labor cost of the adoption of these new standards for the 606, topic 606 and 842. And we find that the firms after before the implementation, we find they prepare, and the number of people that they hire is like 3 people on average more for the lease standard, and 1 person more for the revenue recognition standard to cope with this new 606 topic.
So we apologize that we are not aware of your paper. If you like, please send us your latest manuscript. We would love to kind of cite it. I think this is kind of a trendy topic. Like normally I don't work on very timely topics, that this is the first time I work on something that every 2 weeks I find a new paper related.
We just finished it 2 days ago,
yeah.
So it's a rough
I'm glad that we didn't kind of like purposely ignore. Yeah, but we would love to take a look at the manuscript and incorporate that in our draft. Yeah, so I think it's just that in summary, there's unprecedented adoption efforts. And then before identifying and then analyzing those sales contracts, it's very even hard for those firms in 2014 to tell external stakeholders that I think implementing this new standard is going to accelerate, not change or delay my revenue recognition and reporting numbers after 2018. So that's kind of like the tension, because I think if right now we are sitting in 2022, when I present our documented magnitude to Bob, Bob Hertz would say, everything is kind of intuitive to me. All your explanations make sense. But he thinks that the tension will be that ex ante before implementation, a lot of people actually do not really know the exact outcome will be. And then it's also nice to actually summarize it for users when they actually receive any numbers sourcing from accounting revenue, they actually get a sense of the acceleration and also the magnitude itself. Okay, so as I mentioned, we actually try to be comprehensive. Like one thing that our research is incremental to Wall Street Journal's articles is that we are able to present evidence based on a very representative sample. So here, based on all US listed adoptive firms, we are able to document the average effect. Okay, so before adopting 606, if you see $1 revenue recognized this year, next year you are going to see another $1. just on average. After adopting 606, next year you will only see 55 cents. And we interpret that as acceleration. That means that a company's revenue generation cycle significantly shortens from 24 months to 18 months. And then they record everything and then finish that reporting and the recognition within 18 months after 2018. And then for all the kind of users, the number we want them to remember is that, remember the numbers you see from 2018 involves a kind of 22% acceleration. Please do not attribute that acceleration to organic growth. If you are going to use historical revenue growth to budget your future capacity, don't mistreat that as something that you actually need to prepare more capital or labor resources. For capital providers, be mindful of this effect, and then don't assume that the company actually generate more sales growth from their business fundamentals. So this will be that kind of like the first group of the audience we like to communicate with. The second group of the people we like to communicate with are standard sectors, right? So that after the magnitude, they want to know why. What is exactly driving that 22% acceleration? So we go back to that 5-step conceptual kind of like steps that they want all the firms implement. And we identify the sources of that acceleration. The first one is from the step 2. When they identify performance aggregation, like I mentioned before, those are more granular, generally more granular units in a bundle customer sales. And expose, what they find out is that most of those bundle sales involved some physical goods and some performing services. And as long as those physical goods are delivered relatively early of the contract period, then or revenue cycle period, they are more likely to actually recognize revenue upon delivering of those physical goods instead of waiting till the end. So the classic example would be technology, that when we buy our mobile phone bundle with 2 years of services plus the app updating services, before 606, those technology firms will wait till the last day or relatively later of the process when uncertainties are resolved in order for them to actually recognize revenue. And after adopting 606, after they deliver the physical good to you, they are able to recognize the portion of the contract revenue for the physical goods. And so in general, when there's more granular units, it's more likely that the physical good delivery would trigger the acceleration for that producer or manufacturers. The second sources for the acceleration is the step 3, when the firm are required to determine transaction price. For variable considerations, before 606, firms are required to wait till all the uncertainties are resolved in order to recognize revenue. So variable consideration is any transaction prices are contingent on future events. So one example would be companies shipping their physical goods to distributors and conditional on whether the distributors are able to sell those goods to the end users and customers. That would be the time that the original producers can recognize revenue. So think about car dealerships. That will be one example. After 606, firms are required to actually come up with an estimate. When they ship those goods from their warehouses to the distributors, they need to come up with their best estimates they don't think will reverse in the subsequent period, and they are required to recognize revenue for those contingent variable consideration. And that's actually a second sources of acceleration we see in the magnitude we document. The last thing is the 5th step, is that for very long-term contracts, usually we see in the construction industry, those firms tend to use the percentage of completion method. And if any of you have taught the percentage of completion method in class, before 606, firms are required to use the cost incurrence. So when the construction workers start building that property, as they finish some of the floors of the properties, that's the time the developer actually can recognize revenue. After 606, it requires recognition when the performance obligation is met. That means that it's based on the control transfer. So after the workers finish the first floor, if the developer transfer the first floor's ownership to the customer, then that will be the time the revenue can be recognized. So as you can see, there will be a delay for firms using the performance percentage of completion method before 606. But unfortunately, we don't have enough data after the post period because our sample period ends in 2020. We need more periods actually in order to actually show evidence for this delay. So on average, we show the acceleration related to the first 2 points I lay out, but like for the delay, so far we don't have the time series to have enough power. But going forward, as time passes, we are able to probably see the delay for this subset group of the construction firms. Any questions? Okay, so the last part of the paper is a little kind of like remote, but this is actually directly come from kind of Waqar's previous experience, that some of his clients actually are probably more proactive. So when they identify sales contracts, they would just also amend those sales contracts to make sure that later on when they have to comply with this new standard, it's very easy for them to identify distinct performance obligations. It's very easy for them to determine transaction price and allocate that price to different performance obligation. So one thing we did in the paper is we try to see that how often sales contracts from 2014 till 2020, for those adopting firms, they incorporate more and more 606 related keywords or jargon in the sales contracts. And those kind of like not directly to the recognition measurement, but it's kind of in the background for them to actually easier to actually implement the subsequent 4 steps. Okay, so the last part, group of the people are all of you. Like we would like to communicate with academic researchers. We hope to introduce a new empirical model that's kind of complementary to many of the novel approaches you already have invented, but just give you one more things to your toolbox going forward when you are interested in testing accounting regime changes or accounting incentive differences across firms. So pretty much the research question is that we want to see when this accounting regime changes from pre to post period, how can we identify the measurement effect attributable to these regime changes, not attributable to fundamentals or other or medical related variables, right? So the method we propose is the following, is that we try to directly identify 329 time varying industry shocks. So you can think about in the US economy, among US listed firms, there are probably 3,000 plus firms. We are going to kind of like on average classify 10 firms, group them into one industry, assuming that they behave similarly and share very similar revenue generation cycle among those 10 firms within an industry.
So
yeah,
there's a question. Yeah.
Hi, Ayung.
Yeah.
So here I have a question. I don't know whether I missed anything or not, but you just mentioned in your presentation that since like there are other people, perhaps from Wall Street Journal or other researchers, have done or have tried to quantify the impact of this new 606. Is that right? What did you say that?
Yeah, I think if you look at Wall Street Journal articles or each individual firms, they will talk about their specific situation.
I see.
Yeah. So,
I see.
Yeah.
So when I was reading the introduction, perhaps you mentioned all this later in the paper. When I was reading the introduction, it seems like you just jump into this new method, and I'm wondering if it's possible or if it's better to discuss what is the most intuitive way to do this and what is the problem. For example, right? You mentioned the confounding impact of both fundamental change and the accounting rule change. So what I'm trying to think is that possible to kind of talk about that and say, hey, you know, these methods have these problems, and we kind of and I use that as a motivation for a new method. Does that make sense?
Yeah. Yeah, I think, well, let me clarify. I think you will appreciate the paper will be written more like a methodology paper, right? Is that if in general, we are going to actually document the effect, recognition effect from accounting rule changes, what are the things people have used, and then why this new method will be incremental or complementary to the existing method. So it's more like a methodology paper for
Yeah, it's right. Right. I guess perhaps it's just some small writing issue in the second paragraph. Like before jumping directly into the new method, perhaps talk a little bit about what kind of method have been used in practice or in other researches, and then kind of use that as a motivation. And
yeah, we definitely can do that. I think we do that later in session 2.2, but probably it's a little too late. And then later on, kind of like page 4 or 5. But we definitely can kind of summarize for everybody before we kind of introduce our new method. Thank you. Yeah, so the method is like kind of like, you can think about for those 3,000 plus listed adopted firms, we kind of classified them into 329 different business models. Right, and then within each industry, there's a time varying shocks actually arriving every year. And then we are actually going to see the mapping here, just the covariance between those time varying shocks and how does that are incorporated into the different periods of the firm reporting revenue. So reported revenue can be the contemporaneous, the same year, the year before, the year after. And then we continue kind of measuring or capturing this mapping, but the pre-period actually serve as a benchmark for us to actually attribute what happened after the adoption. So one thing kind of really sad about this adoption is that all the firms feel that the adoption costs are so high. All of them adopt at the same time in 2018. Everybody wait till the last year. Out of the 3,000 firms, only 30 companies voluntarily adopt in 2017. So you can see that that kind of tells you how costly for them to change their internal information system. But it's very sad for empiricists to actually find out there's no stagger implementations, right? So that's why we utilize this 329 time varying shocks to actually model this mapping during the period. And then unless those 329 shocks structure actually changed dramatically around 2018, we can attribute whatever we documented and see the changes in the mapping to the adoption of 606. Does that make sense? So that luckily the adoption is in 2018. If they adopted this new standard in 2020, then I'm not able to tell you that changes in this mapping is due to 606 or COVID-19, because that is a major shock that affects the vast majority of the industries. But 2018 seemed to be a kind of like normal year. That's maybe there's some idiosyncratic shocks changing some of the industry's processes, but we don't see any macro shocks change all the industry's processes during that 1 year. And there are some kind of distinct features of this, this approach. First is that we argue that those industry shocks are kind of like capturing output or input equilibrium prices or quantities, and those are unlikely to be influenced by individual firms. In other words, those are external factors seem to be exogenous to individual firms' choices. So you can think about like individual companies like Kellogg is able to influence their kind of Kellogg brand cereal consumption, but it's unlikely Kellogg itself is going to influence an average American or average kind of citizen around the globe consuming how many pounds of the cereal per year, right? So the aggregate consumption or prices tend to be an equilibrium outcome from many participating firms around the globe. And those are useful for us as empiricists, as exogenous shocks for us to see the mapping from the shock to the revenue, but not vice versa. The other thing is that we claim that those shocks actually are unexpected to managers. So it's not something that they can participate and then in advance book some revenue in advance before they see the shock. And later on, we validate that assumption by seeing that if the shock occurs in 2020, revenue recorded in 2019 has no associated with the shocks occurred in the future. The third is that you may wonder that, well, this is the industry shocks is still very coarse. It's not as specific as firm-specific kind of factors or variables, right? So potentially we don't have enough empirical power to see whether those industry aggregate prices or quantities actually related to the individual member firms' reported revenue. And then that is something we can kind of like bring to the data and then see whether we still find positive associations in the shock year, whether the reported revenue are correlated with those shocks we identify. And then lastly, the shocks actually is measured on the annual frequency. It's actually a low frequency, but we can still use that low frequency to test that whether the shocks actually are sensitive to the length of the revenue cycle. So in other words, for firms like construction firms with a life cycle, a revenue cycle expanding more than 1 year, we should see a positive correlation between the shock this year and the revenue reported in the subsequent year. And we should not see that for a short cycle firm. So ex ante, we are able to classify firms into different lengths of cycles to validate that whether our shocks indeed are sensitive to the reported member firms' reported revenues. So any questions about the methodology? So kind of like alluded to kind of what Ayung just talked about, that there are many different approaches has been used in the literature. From the earlier years of the earnings properties literature. So the downside conceptually, that approach is that they don't really incorporate business fundamentals, right? You simply impose a homogeneous statistical process across all the firms, and then you assume that's correct, but very little room for us to actually map that assumption with what actually happened in practice. And then empirically, we are not able to implement a random walk process because you are going to compare apples to oranges. So in 2017, the revenue is reported under the old information system. 2018 is reported under the new system. Most of the firms use modified approach, means that they don't restate the 2017 number under the new standard. So we actually find a negative correlation because there's a cumulative adjustments plug into the retained earnings. The second approach is that why don't we use liability accounts that deferred revenue in the balance sheet to actually infer how much revenue would come up next year. So if you remember, deferred revenue pretty much reflects advance payment. If your customers pay you before you perform your services or deliver your goods, then you have to book this liability account. It doesn't really address all the sales contracts, all types of the goods or services. It's only conditional on advance payments actually are present in that sales contract. So when we use the deferred revenue to actually predict future revenue and then to test the 606 effect consistent with acceleration results, what we find is that after 2018, more and more firms actually record deferred revenue in a year when they experience the shocks. Means that advance payments becomes actually more popular contracting kind of like terms in the sales contract after 2018. But we don't know whether that is related to 606 or just industry or practices have changed after 2018. The third is that this relates to kind of Stephen's paper kind of presented 2 series ago about whether we can use cash flow as a benchmark to judge whether or predict when accruals will come up, right? So that we can also go back to infer the cash collection from customers by looking at the beginning and ending account receivables and assuming all the sales dollar amounts are on credit to infer the cash collection. But again, if you remember from the long-term contract revenue recognition, cash collection process tend to be kind of independent of the revenue recognition process and independent of the cost incurrence or other economic activities kind of like occurrence. So like whether this cash collection process actually serve as a benchmark for us to gauge when the revenue will be recorded across firm, across industry, across time is kind of like questionable. And then when we use this number, what we find is that there's a bunch of irregularities. That's cash flow this year is negatively correlated with revenue reported previously, in the future, but positively correlated with the current year, and pre-post 606 has some irregularities we are not able to explain. The less commonly used approach is the cumulative adjustments, right? The number is disclosed in the form 10K whenever the company assumes that determines that the adoption is actually material to the firm's investors. They have to report this cumulative adjustments to retain earnings at the beginning of their adoption year. So if they are going to adopt this new standard in 2018, January 1st, midnight, they have to record this cumulative adjustments to the beginning balance of the retained earnings. After we review probably 10, 20 firms reported cumulative adjustments from 10Ks, what we find is that this is actually a conditional impact, really conditional on how many the period has passed before the adoption period day. So let me explain it better. So like in our model, we try to actually document the average effect in terms of acceleration, no change or delay over a complete cycle of the revenue generation process. But here the accumulated adjustments is conditional on under the old standard versus the new standard, how much revenue has been booked up till that January 1st. And then it really depends on, for example,
and I can just add a little bit here if you want. So in the cumulative adjustments, there are a few things that are handicapped in terms of identifying the complete revenue cycle. So a majority of compliers adopt the modified opinion approach, and the retrospective modified approach would mean that they would have to simply restate pending contracts at the period end pertaining to the last period. So that kind of limits our analysis to just a few months before compliance, which does not do justice to completing the entire revenue cycle in terms of analyzing it. Second, the modified opinion itself is voluntary for the people that do provide the full retrospective comparatives. For them, we are unable to draw a like-for-like comparison. And I think that the cumulative adjustment gives us a very small window to capture the revenue generating process. So if we do have to go back to 2013, we are unable to, because the most we can do is the 2018 minus maybe 3 months of pending contracts outstanding at the year end 2017 to 18, which we will get the comparisons of. So I think the revenue generating cycle completeness is the main issue here, which our method kind of adds more credibility to.
Yeah, I think so let me summarize kind of like the reason we don't use accumulated adjustments to retain earnings. You can think about like if there's a revenue cycle is 12 months, whether the new measurement system compared to the old one is actually accelerating, no change or delayed. We're very different if we look at entire 12 months versus the first 6 months, right? If you only look at a partial month, potentially there's some fiscal good delivery will actually distort the whole picture. And what we try to capture is that what the firm will actually record their revenue ex ante throughout the entire cycle, but accumulated adjustment is contingent on what has been booked for those partial months. And it's kind of ad hoc, really depending on when the firm's reporting period cutoff is. Yeah. So I think in the paper, we give kind of more specific examples that what we see is that firms, we documented as accelerating revenue recognition, but in the end, when we look at their 10K, they reported a negative amount adjustments to the retained earnings. That seems kind of counterintuitive. So when researchers kind of like try to measure accounting standard changes, the first thing is like go back to the disclosure, right? See what they tell us. If they think it's a material impact or the adoption is complex, we take it as granted, right? That what they told us will be the truth. I have a kind of like 2012 21 TAR paper find out that actually very often firms are able to remain silent, even indeed there's a material events affecting those firms. So we try to identify those material events independent of the firm's disclosure, and they use that to actually evaluate whether firms remain silent or actually truthfully report. And it seems that there's a lot of firms are able to actually remain silent by aggregating some of the material impact with other transactions or events. The other thing is some studies have looked at what I talked earlier is that post-adoption revenue disaggregation presentation, or using the fiscal year end month. And the fiscal end month, again, is a voluntary kind of choice, and then highly concentrated within some industries that, for example, retailers will always report in their fiscal years in the first quarter rather than the fourth quarter. And lastly, there are some studies that I mentioned before, like a new passive paper, analyzing industry-specific rule changes, and that is subject to small samples. So we think that our method just that complements many other things that researchers have used, and then sometimes even help researchers to validate some of the measures they use from the existing approaches. Okay, so this is the time I'm going to talk a little bit about theory. So our framework actually is motivated from some of the theoretical models in accounting. So usually those models will consider 2 periods. So dependent variable, or the left-hand side will be like, we want to know whether a bunch of goods or services delivered to customers, the dollar value of those will be reported in the current period T or the future period T plus 1. And then that choice of the 2 periods is simply just for the convenience of a modeling, right? Because this omega T is actually just a reporting system or information system. If everything is reporting the same period, there's not much choice we need to actually articulate or study. So most of the theoretical models will actually have at least 2 periods, and then this omega T will actually characterize how those delivered goods or services are going to be mapped into or reported in the current period T or the subsequent period. And then that motivates our measure of, we want to actually characterize the dollar amount recognized in the subsequent period T plus 1 relative to the $1 per period. And then the right-hand side will be that there's some realizations of a stochastic shocks that say that, and then that just captures day-to-day business fluctuations that managers will monitor all kinds of the output market, input market prices and the quantities to actually adjust their capacity, resources, planning, and also their selling prices. So those are the things that kind of like they monitor continuously for them to determine the dollar value of the shipments and the services delivered to the customers. And that motivates our measures that we want to capture this delta T, this realization shocks directly. So we are able to actually examine or capture this omega T empirically. So the direct observation from this framework is that the revenue in our model doesn't follow a random walk, because every given year or reporting periods of the revenue incorporates at least 2 periods of the shocks, right? It will be the current year and then also some leftover from the previous year. And then we have not defined the functional form for those business shocks, so that those can be any processes, any statistical processes. And then we kind of relied upon the actual time series to kind of speak itself about like what the fluctuation form, functional form will look like. But in general, like we are not able to actually simply assume a random walk process for reported revenue over time. Okay, so empirical proxy, the novelty here is that we need to directly identify them instead of using statistical assumptions. So we identify those 329 industry factors from 2012 to 2019. The data comes from IBISWorld. The only proprietary information we gather from IBISWorld is their industry analysts' proprietary selection of a primary factor for each industry. So we rely upon their expertise to tell us which factor will be the most prominent, important indicator or factors for that particular industry. But the data actually coming from publicly available government websites and the data sources. So government tend to kind of keep track of all those transactions at a very granular establishment level data, but like publicly, they want to actually protect some of the firm's proprietary information. They tend to disclose only the industry level data. So IBIS World is actually very good at consolidating all those different agencies publicly disclose industry data and put together on their website. So for example, you can think about that they identify annual precipitation in inches as a demand indicator for these water iteration systems. So when there are a lot of rainfalls, we don't need to actually need or demand that much iteration services. The same thing that suddenly if in the US, per capita, everybody consume more fruit and vegetables, we will see the manufacturers producing canned fruits and vegetables actually report more revenue. So all those factors have a very different units depending on its price or quantity and then their unique units. So we actually go through a standardization process to actually make sure they are comparable across industries. And also we apply a time series adjustments to extract the shock. So like we use an AR1 process to actually extract the shock from the time series. And then we assume that those other things are unexpected. Those shocks we generate are unexpected to managers. Anyone has questions? Okay, so the empirical model is very simple. The right-hand side simply just that shock we generated based on the AR1 process for each industry for each year. The dependent variable will be the year before prior T-1 member firm's revenue the same year versus the subsequent year. We estimate these three equations from a simply unrelated model, and then we demean all the variables by year averages to adjust for any macroeconomic conditions or demean by firm averages. Then that would be something similar to the firm year fixed effects in an OLS model.
Do you have a question?
Yeah. So Ayung, I was just thinking about like what is the mechanism that or like the idea behind like why would you look at industries since the new revenue recognition standard now is more homogeneous? Like why would you think this you'll estimate this parameter based on the industry?
Oh, so I think if you remember this framework, when you talk about homogeneous, it's the omega T.
Yes.
But I think after the adoption, previously there are 200 different omega T. So you can think about before 606 were omega JT. And then after 606 will be omega T for everybody.
Exactly.
However, we would not say after this adoption, all the firms' business models are homogeneous, right? So like the purpose of identifying 329 industry shocks is try to capture this data. And that actually capturing service firms, manufacturing firms, agriculture firms, producing different nature of goods or services or sign different type of contracts or have different customer relationships. So like our purpose is try to actually use that 329 time varying factors to capture the different natures of the business models and the nature and features of their goods and services. But hopefully we are able to estimate this omega T using the mapping from theta to the reported revenue. Yeah, so that's the idea. I know it's a little confusing, but it's something homogeneous, but like we want to capture a heterogeneous process,
right?
Or business model. Yeah.
Right. As you said, like before, of course, there were all like different industries and different standards based on the industry, right? That the firm had to follow in terms of their revenue recognition. But now it's just one standard. So now, like going back into that complexity.
Yeah. Does that address your question? Yeah. Okay. All right, so we run kind of like 5 different specifications to kind of like check the robustness of our model. The first one is that we exclude financial firms because most of those ideas from those theoretical models come from the Cobb-Douglas function, so that usually are for productive firms. And then the second model, we include financial services. So here, mainly we want to capture those asset management firms tend to sign very long-term contracts with their clients. The third is that we try to come up with a pseudo firm-specific shock. So thinking about like even our data is only at the industry level, we are able to use a segment reported revenue to actually weight a shock and then come up with a weighted average measure shock for each individual firm. So that kind of like come toward closer to a firm-specific measure on the right-hand side. We also restrict to the December fiscal end firms because our shock is measured from January to December. And lastly, as all of you know, year 2020 is a crazy year that doesn't really fall into our normality assumption in our model. So whenever we have a shock year 2019, T+1 revenue will be 2020, and that will be the time like a lot of things we potentially cannot explain. So we dropped that year of the shock in the last model. So this is just a validation test. We find that there's no particular association between revenue reported in the year prior to the shock's occurrence. So it seems that the shocks actually are unexpected by those member firms. However, within the same year, there's a significant association, seems to be kind of like relevant for those member firms' revenue recognition. The same thing as the subsequent year, T+1. And the main measure we need to actually kind of characterize that omega T or the revenue recognition is this ratio. Is that so 81% means that 81 cents of revenue recognized in T+1 relative to $1 recognized in year T. And we can also use this ratio to calculate the duration of the revenue generation cycle. So across these 5 models, the average will be 21 months. And across these 5 models, the 3 standard deviation ranges is actually quite narrow between 19 and 24. So it doesn't seem that the model is too noisy within a large sample across time. The second task we have is we'll partition our sample based on the ex-ante identified revenue cycle. So like you can think about companies tend to sign very long-term contracts with their customers. Think about that your contract with AT&T, your private wealth or retirement fund contracts tend to be very long-term. Or think about that some of the industry has a very long or complicated global supply chain. Those tend to have a very long revenue cycle. And once we partition, what we find is, again, there's unexpected or insignificant association between revenue recognized before the shock's arrival. However, after shocks arrive, only the long cycle firms, T+1, the subsequent year's revenue, is associated with the previous year's shock. For short cycle firms, everything seems to kind of like complete within 12 months. In terms of magnitude, we estimate that our long cycle firms revenue generation cycle is 26 months, short cycle firm is that 15 months and significantly different from each other. So again, this is just a validation test to see whether our annual frequency shocks actually are sensitive to the duration of the revenue cycle.
So Ayung, you now have 5 minutes uninterrupted to wrap up. And everyone, if you have questions, please just hold until after the presentation and then you can ask. Okay, thank you.
Okay. So the main result is this table is that finally we partition our sample into pre and post period. And then what we find is that during the pre-period, like I told you before, the cycle is about 24 months, post period is 18 months. So there seems to be a 22% average acceleration across firms. And another test is that, is there any cross-sectional effects? So expectedly, long cycle firms will be more sensitive to this acceleration, right? Because they started with a longer cycle. So whenever they accelerate, the magnitude in terms of number of months will be greater compared to the short cycle firms when they complete their cycle within a few months. So think about short cycle firms will be McDonald's that drives through. You place your order from the intercom, and then you complete your transaction with them within a few minutes. Even they accelerate, we are going to capture just a couple seconds difference, and it's actually less likely to find any statistical significance. But indeed, they also accelerate their recognition process. So what we find is that for long cycle firms is from 8 months to 14 months, and then the change is statistically significant. For short cycle firms, mainly is after we drop the 2020, we do see there's acceleration, but the magnitude is actually not very significant because the nature of their short cycle. The last test is that we show that there's increasing usage of 606 jargons in sales contracts. And the firms tend to kind of incorporate more and more of those keywords in when they sign contracts with customers. So in general, for future research, we propose this methodology for researchers to actually compare reported numbers across accounting regimes. They can also compare reported numbers across different managerial incentives, right, in a large sample over time. For study specific, the examining the 606, they can actually use our Appendix B to actually partition their sample based on the length of the revenue cycle. And as time passes, we hope that either us or other researchers can examine this percentage of completion hypothesis. That's currently we are not able to find any power to test that hypothesis. And lastly, for practice, we would like the standard setters to know that there's an important measurement impact and also the real contracting behavior changes after firms adopt their new standard. And lastly, we want to talk to all the current and the future users of accounting revenue that do not misinterpret this 22% acceleration as any organic growth when they consider capital investments internally or rebalancing their investment portfolios, or even read the GDP growth number. Okay. So last but not least, the next event will be in 2 weeks, and Alon and Gail will present a paper about macroeconomic disclosures. And Steve, have a question?
Is it time for questions now? Yes, okay. The acceleration result is one that's, of course, gives us attention. And of course, this will settle down after you get from the transition period to regular with the new standard. If in fact you have no growth in contracts, you'll only get this if in fact you have growth in contracts. But it is a warning to be careful how to interpret revenue growth, as you say. Mm-hmm. However, when we're interested in analyzing firms, we're not just interested in revenues, but what we make from the revenues, okay? That is, we're interested in profit margins. So I think a place for a very useful endeavor, future endeavor, not for this paper, which I congratulate you for, by the way. It's a very good exhibit of the type of paper we want to see on the accounting design project. But get back to the point. We want to understand the profit margins, okay? So a question would be, yes, you get this acceleration in revenues, but how does that affect the profit margins, okay? Given that acceleration, does it really mess me up in terms of getting profit margins, which are predictive profit margins to the future? Because after all, we're interested in the earnings we're going to make from revenues, not just the revenues. And it may be the matching's more difficult, maybe profit margins deteriorate, maybe profit margins improve. So I suggest you that may be a very significant, important endeavor to take on from this paper.
Yeah, I think, Steve, I thank you, because I think Waqar and I are thinking about this next paper we are going to work on after this is the matching principle, right? And try to identify different cost and expense line items and how does that correspond to revenue after this 606 adoption. And hopefully we are able to kind of say more about profitability at different levels, either gross margin or operating income level.
So now it's 12 o'clock. So I think this is 1 hour perfect. So we can probably stop the recording. And then if you have more questions, because I saw Ayung was raising hand as well. So then can stay and chat.
Yeah, we are.
Yeah. So actually, I want to follow up on Steve's